Good morning, everybody, and welcome to the June edition of the IMAP webinar series. Today, it's really interesting for me because asset allocation is central to the outcomes for so many of the decisions that advisors make and portfolio managers make in establishing managed accounts. And today, we're going to have two of the leading managed account providers, two of the longest established managed account providers, talk about alternative aspects of asset allocation. In today's session, we're going to have Watershed, one of the originals in establishing MDA-based managed accounts and now more lately SMA portfolios as well. Talk about asset allocation, their views of the outlook for individual markets, and how those views then inform their portfolio construction determinations for the portfolios they run for their clients. And then following Adrian Rowley from Watershed, Michael Lagudi from Morningstar, perhaps the largest portfolio manager for all the managed account providers in Australia, is going to be talking about a particular aspect of asset allocation, and that is sequencing risk for those approaching retirement and how their views of managing sequencing risk and their views of the markets today determine how that particular type of portfolio should be managed. But before I ask Adrian to speak, I'm going to just say a little about the upcoming events for IMAP over the next couple of months. And the middle of the year really is the time in which we focus mostly on the investment management components around managed accounts. So there are three things I've highlighted. The Managed Account Awards, for the last couple of months, a panel of extremely patient judges have been reviewing the many entrants that we had for our Managed Account Awards across 5 asset classes: Australian equities, small caps, multi-asset class, fixed income, and others, and the Licensee and Innovation Awards. And we'll be announcing the winners of those on the 25th of June at an event in Sydney. If you'd like to participate in that event, come along and support the finalists who are on our website. We'd be happy to see you there. Watershed, I have to say, this year again, a finalist in a number of categories. On the 6th of August, we'll be running our Portfolio Management Conference. This year, this being the 3rd year we've run the Portfolio Management Conferences, we've split the Portfolio Management Conference into 2 parts. In August, we'll be talking about the topics we're going to be talking about today: asset allocation, risk management, manager selection, portfolio construction, the strategic issues which face portfolio managers. We'll have a number of sessions, including how to build a framework for asset allocation, how to incorporate ESG considerations into portfolios, and the like. And then in October, in Melbourne, we'll be looking at the more sector-level investment decision-making. So this is the first time in which we've split the strategic issues from individual sector management. So I'd welcome you coming along, participating in our Portfolio Management Conference. And then the final thing I wanted to touch on before handing over to Adrian is a Responsible Manager Masterclass. In these days of heightened awareness of issues of compliance and regulatory oversight, the responsible manager forms a crucial part of the operation of advice licenses. And so many advice licenses run MDA or other managed account services. And so at IMAP, for the last 4 or 5 years, we've been running a specialist RM class, a full day with the Fold Legal, focused on issues that need to be understood and addressed by the RMs of a license that's involved in either managing or giving advice on managed accounts. You can get details of that from our website. So now let me hand over to Adrian Rowley and ask him to spend the next 20 minutes or so talking about their view of markets and the key drivers of those, and then how that informs their view. If you'd like to ask questions, there's a chat function at the bottom of your screen which you can use, and we'll just interpret those questions back to Adrian. And there'll be a time for questions at the end of Adrian's session and then at the end of Michael's. So, Adrian, over to you.
Okay, thank you, Toby. Hopefully you can hear me clearly. Disclaimer, I'll flick straight through that one. So what I wanted to talk about today, and we don't have a lot of time, was just some of the things that we're thinking about that drive our asset allocation and how our multi-asset portfolios are positioned. Very simply, there are a few key considerations that we run through when determining how the multi-asset portfolios should be structured. So, you know, the first and most obvious decision is the allocation between growth and defensive assets, which really is driven by our economic outlook and current market pricing. Within that growth component, we then need to think about how much of the portfolio should be invested domestically versus overseas. And then the third layer is to then look at the sectors that we want to be overweight or underweight within each of those markets. And from an overseas perspective, the region, and importantly, the currency. So that's the sort of process that we run through, and I'll just run through a few kind of slides on our current thinking and current positioning for those for the growth component of portfolios. From a defensive component, we obviously need to think about whether we want government bond or corporate bond exposure, whether we want to bias to fixed or floating rate securities, or cash or defensive alternatives. I don't have time to run through that component today, but I can touch on it. The important point to make, though, is these are all levers that we have to pull within a diversified multi-asset managed account. We can make changes to all of those tilts very quickly and efficiently under a managed account structure. Okay, so how are we currently positioned? Well, the obvious point and concern at the moment is that we're getting, oh, is that? You need to share your screen. Sorry, technical difficulties. Let me just make sure that we're sharing this properly. Here we go. I think we're back on track now. Sorry for that. Okay, so the first slide here, and the key consideration is the mixed signals that we're currently getting from equity and bond markets. This chart here, we've got the MSCI World Index in red. So you can see the phenomenal rally that we had in 2016, 2017, the sharp correction that we had in the December quarter, almost 20%, but we've now bounced back to near record highs on the MSCI, and slight differences from market to market, but we're basically near record highs. If we look at bond markets, in blue we have the 10-year US government bond yield, which peaked at about 3.2% just in September last year. That's now 2.14%, so it's come off a full 1%. And over the last 3 or 4 months, equity markets have rallied back to near record highs. So there's a huge dislocation there. You've got bond markets telling us that global growth has really rolled over, but equity markets saying, hey, we've now got more accommodative monetary policy globally, so asset prices will reflate, the economy will pick up, and off we go. I think at the moment, from our perspective, there's not a strong conviction in either one of those yet. So if I look at our current growth setting within our balanced portfolio, we've got an allocation of just over 48% to equities. Now that's versus or against our 60% neutral setting. So for our balanced portfolio, it's a 60-40 sort of growth defensive split. Our equity allocation at the moment is 48%, and we have a large cash allocation. And I'll just run through the reasoning there. If we look at the global growth outlook, global growth is really struggling to find a bottom at the moment. So if we look here at the leading indicators, all of the main regions of the world, leading indicators across all main regions of the world have declined pretty sharply over the last 12 months. China, the orange one there, showed some signs of bottoming at the start of this year, but the May data that we've gotten over the last few weeks has been really weak again. The leading indicators for the US have softened quite a bit. And the euro area is in a pretty ugly space at the moment. So leading indicators clearly still pointing down and haven't found a bottom just yet. If we look at China, and we spend a lot of time thinking about China, in our view, whether the stimulus being applied by the Chinese government picks the economy up in the second half of the year will be the key determining factor as to whether equity markets continue to grind higher over the course of this year, or whether they roll over again and we end up with another short-term sort of correction like we saw in the December quarter last year. Now, China has started stimulating the economy fairly aggressively from late last year. And I won't run through all the things that they've done, but they've cut tax rates, they've cut the VAT rate, they've increased social infrastructure spending, they've cut their reserve requirement ratio or lending rates. They've done quite a few things over the last 6 months. And we saw some green shoots appear in April, but all of the data for May was much, much weaker again. The left-hand chart here just shows Chinese retail sales. So from 15 to 17, you had retail sales growing in China at sort of 10, 11% pretty consistently for 3 years. Over the course of 2018 and into 19, they've declined really, really sharply. The right-hand chart here is just the manufacturing PMIs in China. So leading or manufacturer surveys, a good leading indicator. And again, in May, they all turned south fairly aggressively. So the headline PMI number dropped below 50 again, which is indicating that it's in contraction. But the really concerning one here for us was the new exports number, which is down near 46, and has been weak for the past 6 months and well below 50. That to us is an indication of the real impact that the trade wars are having on Chinese growth and in turn the global economy. Okay, so touching on the trade war now, and again, markets have been priced and are pricing a pretty swift resolution to the trade war. And really, we probably don't have any better insight into that than most. But what we can say is that it is having a real impact on global trade, which again is a very strong leading indicator to the health of or barometer to the health of the global economy. So if you look at this global trade chart going back all the way to the 1940s, you've seen global trade increase at a rapid clip, particularly from the early 2000s when China entered the World Trade Organization. Well, it's actually rolled over for the first time really since the 80s. The bottom chart here is global trade just over the last sort of 7 years. And early this year, both the quarter-on-quarter and the year-on-year global trade numbers fell into negative territory. So no doubt this trade war is having a significant impact on economic activity globally. So we're, I guess, pretty cautious on the outlook for the global economy. We certainly had a view and retain a view that the Chinese stimulus will eventually pick the Chinese economy out of the doldrums, and that will have a strong flow-on effect to Europe. But the jury's out as to when that will happen, how long it will take, and how much stimulus will be required to do it. So the next, so we're cautious on the economic outlook. The next piece of the puzzle is then to have a look at how equity markets are priced, to then get a better feel for how we should be positioned relative to our kind of neutral benchmarks. So if we look at, and this, apologies, chart's a couple of weeks old, but if we look at global equity markets, they're fair to fully priced in our view. So the trailing PE on the US market, or sorry, the current PE on the US market is about 18.5 at the moment. 1 year forwards, probably a touch below 17. If we look at the Aussie market, and there's another interesting point in this chart, our current PE today, we've bounced back to 6,500, is about 17.35, and the 1 year forward is a little bit over 16 times. So it's well above the long-term historical average here. The other thing to note there is that actually puts Australia or makes Australia one of the most expensive equity markets in the world outside of the US. It's more expensive than the MSCI, much more expensive than emerging markets and Europe and Japan. So that's cause for consideration as to your allocation between domestic and global growth assets. Okay, so why has Australia had such a huge rally of late? Three key things saw our market bounce from 6,200 up to sort of 6,500, and I won't labour on these too much because there's been plenty written about them, but we had an election result that was clearly more favourable for business and markets. We then had APRA loosening their lending standards, and I will touch on that a little bit, but that is meaningful and significant. So loosening the interest rate that banks could use when determining serviceability for loans from 7.25% to 2.5% above the actual interest rate, which now for a lot of banks is around sort of 3.7%. So loosening those lending standards actually means that the banks will be able to start to try to stimulate loan growth, which will hopefully see an easing of the downturn in property prices and a sharp slowdown that we've seen in housing starts and building and all of those related sectors like retail spending. The third one was that we had the RBA cut the cash rate last week, and a few weeks ago, during that election week, we basically had Lowy come out saying that we are going to cut cash rates, and markets rallied off the back of that. Looking at Australia though, when I touched on that first slide talking about the mixed signals between equity and bond markets, in Australia it's incredibly pronounced. So you have on the left-hand side here, the red chart is the ASX 200. So we're up near 6,500 today, up near a long-term high. In blue, we've got the Australian 10-year bond yield. So you can see from late last year, it was sitting there at about 2.6%. It's now 1.5. So it's fallen a full 110 basis points over the last 6 months. And over that time, our markets rallied from 5,500 to 6,500. Now, if you took that red chart or that red line off the chart and you just showed me this and said, there's the Aussie 10-year bond yield, how do you think markets have performed? You would have expected markets to have sold off fairly sharply, because what that's telling you is that the underlying economy is not doing particularly well. So there is a huge dislocation between those two, which from our perspective warrants some caution, and it warrants some elevated cash levels. The conundrum there is that we're pretty negative on domestic and global bonds as well, because of the rally that they've had. They're incredibly expensive. So we're allocating to cash at the moment. We've got increased levels of cash with a view that one of these is right and one of these is wrong. And either way, we'll get a better opportunity to allocate to either equities or bonds in the second half of this year as the picture becomes more clear. Okay, so looking at the Aussie market, where we've got 110 basis points of yield compression, where we've had one interest rate cut, the markets are fully pricing in another cut, and there are some economists talking about a third cut after that, which would see a cash rate below 1% in Australia. What that's telling you is that the underlying economy is fairly challenged. I've just had the 5-minute wind up, so I better get going quickly. Looking at the Aussie market, at the Aussie economy, the housing market is clearly in decline. All of those policies that have been implemented are designed to try to stabilise the housing market and create activity again. But if we look at the two big parts of our market, this is the April credit growth data for the Australian banking system. It was really soft, and there's a very strong correlation between lending growth and housing prices. They've been declining there for the last few years. And there's a high correlation between the performance of our market and the performance of banking stocks. And the banking stocks really need loan growth to grow profits. So you've got a large part of the market that's re-rated, but the underlying drivers are still somewhat challenged. So then if I look at the rest of the market, and where we've got the Aussie market at 6,500 today, you kind of question, okay, well, where's the earnings growth coming from that's going to sustain that market level? It's not coming from the banking sector unless you're of the view that the housing market will rebound over the next 6 months and fairly aggressively. And it's not coming from the industrials, it's come solely from the resources sector. So this chart here just shows you the earnings forecasts or earnings delivered and forecast for the different components within our market. This shows you the earnings outlook for the banks. So clearly that deteriorated over the second half of last year, despite banks now re-rating. So you really need housing growth to pick up, loan growth to pick up, and earnings to pick up to justify current valuations. If we look at the industrials, earnings have declined over the last 6 months, which you'd expect, reflecting the challenging domestic economy. But the market overall, we've seen strong earnings growth over the last 6 months, or forecast earnings growth, which is purely driven by the resources sector. If you strip that out, then the earnings outlook would be incredibly challenged. And the only reason that we've seen the big re-rate in earnings in our market is because of the iron ore price and those iron ore stocks. So we saw the iron ore price hit $100. Which has seen massive upgrades from the BHPs and the Rios. So if you look at our market at the moment, those iron ore stocks are trading on Ps of around about 10, with the broader market at a bit over 15, and the industrials at well over 16. So if you strip the resource component out of that, the rest of the market is fairly fully priced. Okay, I better get moving fairly quickly here. Moving to global equities, one of the considerations there, so we are shifting our allocation to overseas equities. We're more comfortable with the outlook for the US economy, even though it is slowing. But we're also concerned about the outlook for the Aussie dollar. This is an interesting chart that just shows you in red here the US federal funds rate. So you can see that they've ratcheted the funds, their cash rate up to 2.5%. Markets are now predicting a cut over the next little while, but they've tightened to 2.5%. In Australia, we've gone from 2.5 all the way down to 1.25. So we've got a cash rate that's 1.25% below the US cash rate. Now, ordinarily, you would expect the Aussie dollar to be far, far weaker than it is today. It's still sitting there at 70 cents. The only reason it's sitting there at 70 cents is because of the strength of commodity prices and the iron ore price. So if we ever did get a position where the global economy softened, where China's economy continued to deteriorate and you saw commodity prices come off, then there's clearly risk to the Aussie dollar there, which would warrant more assets overseas within the diversified portfolio in US dollars. So I'll flick through. This is my final chart now. So our overall positioning, we have higher than cash levels with a view, as I mentioned earlier, that we'll get an opportunity to allocate to either cash or bonds bonds or equities in the second half of this year at better prices. And the key concern there is that given how soft global economic growth has been over the last 6 months, we would expect to see pretty soft earnings growth over the next 6 months. Now, the key question then is, will markets look through this soft period of earnings with a view that accommodative central bank policy will reflate assets, pick the economy up and see earnings growth in 2020 again? Or will we see markets pull back as earnings are delivered? So if we look at this is just the S&P 500. We've had phenomenal earnings growth through 2017 when we had synchronized global growth, and 25% earnings growth in 2018. Part of it due to the strength of the underlying economy, part of it due to the stimulus from the Trump government, but also a large part of it because of the tax cuts that they implemented. Now, we've just had first quarter earnings in the US, and first quarter earnings growth was less than 0.5%. Second quarter earnings will probably be negative, and the market is forecasting the economy to pick up in the second half of the year and for us to see 5% earnings growth in the fourth quarter this year. But at the moment, as we know, the global economic outlook has continued to deteriorate. So we see risk to that. So the key question there is, if we're sitting here at the end of this year and earnings growth is flat, the economy is still chugging along sideways, then all of a sudden the market's not pricing in earnings growth in 2020, it's pricing a flat or downward outlook. If you're starting with equity prices that are full or fairly priced, it's then hard to see decent earnings from this point. So I'm not trying to be too bearish there. We're still 48% invested in equities within our balanced portfolio, but that's about 12% below our neutral setting, with a view that we would rather hold elevated levels of cash at the moment and buy the dip in either of those asset classes. Okay, that's me. So that's a very kind of quick rundown of our thinking at the moment. I'm not sure if we move to questions or the like now.
Yeah, look, Adrian, there are questions which I've got following on from your slide. In fact, as I'd say to those who are listening to this, if you want to submit a question, just use the chat button at the bottom of your screen, and I'll moderate that for Adrian. So the question I've got, Adrian, really picks up on the slide where you showed the cash rates, US versus Australian, and I'm reminded of the slide which Charles Stoddart from Zurich had in last month's webinar, where he had an equivalent slide but for 10-year yields, which also showed Australian rates a full 1% below the equivalent US rates. I guess my question is that telling us something about the comfort that investors have fundamentally with the Australian economy, notwithstanding the point you made about our dependence on resources, the fundamental comfort investors have with Australia compared to uncertainties in the US market?
I probably think it's a little bit the opposite, in that even though money has flooded into the Aussie bond market and those yields have compressed, I think it's been more a reflection of the fact that the central bank or the RBA here needs to cut rates, and they need to cut rates fairly aggressively, because large parts of the economy are struggling. So we've seen housing prices here in Sydney off sort of 8 or 9% over the last 12 months. And if you look at housing starts, they've really dropped off a cliff. And then the other thing, if you go out to 2020, so if you look at construction sort of permits or applications, really dropped off a cliff. So activity at the moment in 2020 is low. And looking at our office window here, there's cranes all over the place in Melbourne, but all of that work is coming to an end over the next sort of 12, 18 months, or a lot of it's coming to an end over the next 12, 18 months, 2 years as well. And beyond that, there's a pretty big hole. So a large part of the Aussie economy is struggling. And the key concern there as well, and we saw that in recent retail sales data, is that when house prices are declining, people then stop spending, so you have a really challenged environment for retail sales, which is another big driver of economic growth in Australia. So really the only two parts that are performing well are resources and infrastructure spending, and that's the big sort of hope at the moment, where Australia's economy has done exceptionally well for a long period of time because we've always had something to pick up the slack. In previous cycles, we've had the resource capex boom, picking up the slack of the interest rate kind of sensitive part of the economy, and then it's gone full circle. But if we look forward now, I think we've got an environment where the construction cycle is coming to a rapid end, the housing cycle is weak, and we really need this big government-led infrastructure boom to try and pick up the slack from the housing sector. And again, how efficient that transition is will be difficult to tell. So I think really it's global markets concerned about the Australian housing outlook and having a view that rates are going lower.
Well, look, thanks very much. Now, Adrian, there's a question from Denby, which is, he says, you've shown some concerning economic outlook data, yet equity markets haven't yet responded. What do you think the lag is before markets respond? And this picks up on your point, I guess, of the potential uplift from infrastructure, or are they overly optimistic and looking through the potential down period?
Yeah, I think they're overly optimistic. I think one of the key issues that we're thinking about is that, if you go right back to the GFC, when you had this really unorthodox monetary policy and central banks just throwing money at the economy, you had a view then that would eventually reflate asset prices. It would get the economy going, and that'd be great for growth assets. The key question now is we're in a really mature phase of the economic cycle, and growth has rolled over. So we're now seeing a return of loose monetary policy, or central banks cutting interest rates, and talk again of sort of QE. So the question is, how effective will that policy response be at this mature phase of the cycle, which we've not seen before? So bulls out there are effectively saying, don't fight the Fed, don't fight the RBA. This stimulus will work, and you need to buy risk assets. But the question that I have is how efficient that response will be, because if we look at the Aussie market, there's been earnings downgrades almost every other day for the last 3 or 4 weeks as we come into the August reporting period. We saw Star Group today downgraded on soft VIP numbers, but also soft domestic gambling numbers. So that gives you a pretty good feel to the sentiment of the underlying consumer in Australia. So we've had a heap of downgrades.
Life's pretty crook in Australia when the gambling stocks take a
Exactly right. That should be defensive spending. That's a consumer staple.
Thank you very much.
If we get to the August reporting period, that's when we really see how companies are performing. And if they're not meeting earnings expectations, then surely I think the market would have to react. So from a domestic market perspective, I think August will kind of give us the next direction. If you look at the US market, I think probably in July, when you get the second quarter earnings season kicking off in the US, that'll be another key indicator for us.
Great. Look, thank you very much, Adrian. Now, look, it's my pleasure now to hand over to Michael Lagudi. Michael is the National Manager for Investment Solutions at Morningstar. As I said, one of the probably the largest provider of managed account portfolios across this booming market. And he's going to talk about sequencing risk and their asset allocation views, and how thinking about a particular class of investor, that's to say those who are within sight of retirement, how you can use your current asset allocation views to offset that risk of. Michael, thanks very much. Take it away.
Fantastic. Thanks, Toby. And hello to everyone sitting in their offices listening to today's webinar. I really appreciate you taking the time out of your day to discuss the ways that you can maximize the probability of clients actually achieving their wealth goals. Now, is that on? Oh, fantastic. There we go. Firstly, for those who aren't aware, as Toby alluded to, I'm part of the investment management division of Morningstar. And most people on the call will know Morningstar for our independence in the data, equity, and fund manager research base. But we are also investment managers. And as investment managers, we globally manage around 280 billion, with the strong belief that by using asset allocation, we can help clients stay invested for the longer term and have a better chance of achieving their wealth goals. Now, as for APAC, our hub is based out of Sydney, as you can see, and it has a substantial presence in our global process. The one thing that isn't well known about our global team is that we have a team of 17 whose job it is to purely do research. The majority of those 17 within the team focus on behavioral finance research and decision-making sciences. They focus on supporting our investment team in managing their investment biases, as well as supporting our advisor network with thought leadership, with white papers, and developing tools to help advisors better engage with their clients. Now, some of the insights that I'll be discussing with you today will be from this team. So today I was hoping to show sequencing risk in action. What I hope to show you are some of the insights into the construction of our multi-asset solutions that help our network of advisors managing sequencing risk and their client investment behavior. So earlier this year, we ran an investment management roadshow and we asked over 1,000 advisors who attended why they love doing what they do. One of the more common responses was to help their clients achieve their wealth goals and their personal goals. So let's assume that most advisors are adopting a client-centric, goals-based or objectives-based, whatever you like to call it, to their financial planning practice. What I mean by this is that they're doing a fact find, learning their clients' objectives, goals, and values, and then devising strategies aimed at achieving those goals. So the investment portfolio in this universe should really be considered just a means of achieving a client's goal. Now with this, SAA-based portfolios have a fundamental problem if you're running a goals-based approach to financial planning. Now let's consider the traditional way an SAA portfolio is being constructed. Now I've just picked a random 70-30 growth manager, SAA manager that is, from their PDS, and I've shown what their current positioning is and the allowable ranges that they have to move. If we consider each asset class now in isolation for a minute, the first thing that we notice is that they have a very narrow band of allowable asset allocation. In this example, Australian equities can move from a current positioning of 27 up until 30% and down until 25. So this typically means that the return objective of this asset class is to beat the ASX 200 or the ASX 300, depending on who the manager is. It can't be anything else. And in combination to this, the positions within that asset class would need to emulate the benchmark due to the agency risk of being sacked if you don't outperform that asset class. So if we continue on with our Australian shares example, all SAA managers would have to hold the big four banks. And we're coming across more and more advisors and managers who find themselves in positions that they have to be in, not because they want to, but because they have to be in those positions. Now, this is the same across all asset classes. As a result, the return objective of the entire growth portfolio is the weighted average. Oh, sorry, we can't hear.
Should be good.
Should be good. Fantastic. We've cranked it. Beautiful. So as I was saying, the return objective of this entire portfolio is the weighted average of each of these asset class indices. And this is often described as being the peer index or the Morningstar Australian multi-sector growth. And the impact of this is the fact that the client's probability of achieving their goals is too aligned to the performance of the market. The sequencing risk remains high. So for example, most advisors will recommend a more conservative portfolio as they approach retirement. And I'll show you this in a little bit of action in a couple of slides. Now, the logic is that is consistent for multi-asset managers who call themselves dynamic asset allocators. They give themselves plus or minus 15 instead of plus or minus 2 in this example of their long-term weightings. And they just give themselves a little bit more flexibility within that asset class, but they still have the same fundamental problems. You might need to be my slide clicker, Toby. Fantastic. So when advisors and managers build multi-asset portfolios using an SAA framework, their first step should be deciding how much risk is going to be in the portfolio. Now, this is not risk in terms of overpaying the price of an asset. So for example, were US shares more risky in 2000 than they were in 2009, but rather risk from a standard deviation and volatility perspective over a multi-decade time frame. Once the manager identifies the risk of the portfolio, they build an asset allocation based on the historic risk and standard deviation of all the asset classes. Then hopefully the theory pays out and all the asset classes have their textbook diversification, and there'll be a sensible investor acting completely rational during the volatile period of the markets, and they'll never cut and run at the bottom of the market. The return will be based purely on the market, and for the advisor and the investor, the probability of achieving their outcome is completely unknown. The portfolio is unable to be adapted to suit the lifestyle needs of the client. Now, we'll put our hands up. We used to manage money like this here at Morningstar, but we had a philosophical change, and we believed that we had a fiduciary responsibility that if valuations didn't stack up and our conviction needed us to be able to protect clients' capital, we should be able to do so. So what did we do? So in 2009, there were two main ways that we helped our investors with their sequencing issues. The first one is by giving ourselves wide asset class ranges. That allows us to take up conviction in our process and allows us to position the portfolio for what we want to be able to do. We also gauge ourselves flexibility in the growth defensive splits. We've given ourselves flexibility in the amount of growth assets at any point of time in the cycle. So for a 70-30 portfolio like here on your screen, we've given ourselves the flexibility to go down to 50% of growth assets when it makes sense to do so. And on the upside, we can go up to 85%, again, when it makes sense to do so. Also, the underlying positions in each of these individual asset class, we've also have flexibility in. So for example, you don't have to take up 50% of our international exposure within the US. We can invest in the international markets that give our clients the best reward for risk. The second approach then was to align the portfolio objective to a real return. By moving to a CPI plus performance objective, it naturally reduces the impact of the market on the client portfolio. In effect, we reduce the sequencing risk by reducing the need of the client to move to those more conservative portfolios. Now, with this wide asset class range and with the CPI plus objective, you could position the portfolios to look completely different to that of an SAA manager. For example, you don't have to hold the 30% of your international bonds portfolios within the US. You can position the portfolio that is going to give you a better risk reward than cash and have the consistency of the real return objective, and to reduce the amount of volatility as clients approach their goals. So when building real return portfolios, the decision-making needs to be completely different. Advisors can understand what their clients are trying to achieve with their wealth through doing an advisor fact find with the client. And then managers, we can focus on providing a return that rises with inflation and maintains the purchasing power of the client throughout the cycle. With the focus on providing consistency and higher probability of returns, the client can set off with a strategy and know the probability of actually achieving their outcome. With a focus on a consistent return, a manager can then focus to position the portfolio and adopt an asset allocation approach that constructs a portfolio to have little risk in the portfolio as possible to achieve their given return. But now risk has to be redefined. It can't be the volatility of no longer aligning to the portfolio construction process. Risk needs to be the permanent impairment of capital. As in, if you can lose this, how much money will you lose in this investment? And is it impossible to make back over the time frames available? It aligns the definition of risk to that of the investor and aligns to the risk of a client not actually achieving their goal. And the aim of the game should not be focused on the size of the return. The aim of the game is to focus on the consistency of the return stream so that the client has the highest probability of actually achieving their goal and the lowest chance of to act irrationally. Or said another way, is you want to get the maximum level of return for a given amount of risk. With great highs and great lows, it completely tests the risk tolerance and the behavior of clients. It is difficult from a logistical perspective to coach your entire client base out of cutting and running at the bottom of the markets and not to overload at the top of markets. And as Ryan Murphy, head of our decision sciences, says, it's like trying to coach your clients to not see a visual illusion. It's about keeping clients invested for the entire duration of their time horizon because we know the client is better off by staying invested. Now, an SAA investment approach completely rejects the goals, needs, and behaviors of the client, but rather focuses on maintaining a consistent amount of volatility risk. As investment professionals, we need to build portfolios that allow us to focus on keeping investors invested for the long term. Now, let's see this come to life. Now, apologies for the simplicity of this graph, but I do think it shows the average client that walks into most advisors' offices. There are multiple goals in this investment journey, just like buying a house or saving for school fees as an example, with all having an underlying goal of saving for retirement. Each of these buckets of money will have a different return profile and different time horizons, and advisors will work through a variety of different ways to get to their magic retirement number to identify the client needs, with most times there being a retirement gap in there, and that's where the strategies and the value of advice lies for an advisor. From there, there's a compulsory withdrawal of capital at retirement age, which continues, and hopefully there is enough capital to last the entire life expectancy. Now, obviously, there are numerous variables and specific client needs, but this is the journey of an average client and where there's consistent value in advice. So let's look at where now sequencing risk plays its largest factor, and let's look at the difference between an SAA approach and a real return approach at these points in time. If we look at the retirement goal, for an example, like Toby said to introduce me with, an advisor would start off at a high growth position, then slide down to growth, then slide down to balanced as the client got closer and closer to retirement. And if markets are benign, then all well and good. The issue is that if volatility and downturn happen just before their review, or to switch them down the risk profile spectrum, and they don't have enough capital to add back into the strategy, they're most likely going to have to go back to work, and essentially all the great work that you've done as an advisor is ruined. The other difficulty is that under the current compliance regimes, that as soon as you move down the risk profile spectrum of high growth to growth and then to balanced, it's very difficult to then be able to move back up. The licensees that I work with make it very difficult to increase the risk profile of a client as they get older and older, even though it may make sense to do so. So then how does a CPI plus wide asset class portfolio situation look at this? Well, let's say you need a CPI plus 70-30 portfolio, and with the flexibility allowed in the solution, you'd have the ability to slide down within the product or risk profile when it makes sense to do so in the cycle. On the converse, once capital is protected and opportunities are now available, you have the flexibility to be able to go and purchase opportunities, often unavailable to a fully invested manager. You could be overweight growth assets without having to slide up the risk profile spectrum. Now, as a side note, managed accounts also make this process cost effective for the end client. If you're running a robust managed account with direct vehicles, you can maintain scale within the practice, you can manage sequencing risk, and there's lower costs to transact for the clients, and also they maintain their individual tax positions. The other period of sequencing risk, which I think is really important, often overlooked, is when the client actually achieves their wealth goal. So in our example, the first few years after retirement. Now, most likely the clients would have planned to spend some money at this point in time, so sequencing risk is a huge issue if drawdown does occur, and combined with the forced withdrawals, the capital will not last. Now, at the moment, under an SAA framework, the best approach to this is to use a bucketing style, keeping portions of a 3-year income in liquid cash, a bucket of medium risk portfolio, and then usually a long-term growth portfolio. And then usually the buckets tip over to supplement the strategy. Now, if we isolate the income and the growth bucket, that is where, in my opinion, there is the biggest need for asset allocation flexibility. Now, in that income bucket, there's a huge need to protect capital as it's the source of feeding liquidity into that cash bucket, yet it still needs the flexibility to position itself to capture some capital growth. It just can't be based on market performance. The long-term bucket, however, can be a little bit more equities or market-based. However, there still needs to be an eye on preserving capital at this point of the client's life cycle. It does have longer time horizons, but the only difference there between using a real return and SAA approach is the flexibility of being unconstrained in the underlying. The question is you need to ask yourself is, do you want a pure market-based capped approach, or do you want a portfolio that is high conviction in its growth via its asset allocation? Now, advisors we work with have reached out and they've asked our investment team and our research team of the 17, under an objectives-based framework, what is the optimal amount that we should be allocating to each 3 buckets? And the answer is, sorry to disappoint, watch this space. We are hopefully going to share with you in Q3, and I hope we'll pass this on to Toby as well to share with the entire network. The other issue of sequencing risk is the investor behavior when it comes to market corrections. As I mentioned earlier, our team of 17 are working on identifying investor behavior and trying to keep them invested through their end goal. Now, under a real return, wide asset class range framework, we don't have to test the tolerances of our investor on the downside along the investment journey. The aim is to cut off the mountains and then to fill the valleys this graph basically demonstrates. This way, we can increase our probability of a client actually achieving their goal, and we're not testing their behavior and take as much sequencing risk as we can off the table. Now, we did get the beginnings of market movement like this in 2018. And we had the beginnings of a market drawdown, but this time around, markets did not lull, further withdraw, and they responded really quite substantially and quite quickly in Q1. Now, I've just included our portfolio experience during this period, even though they have taken a real return approach, obviously focuses on the downside, but with nimbleness and the ability to deploy cash quickly and at scale, there is an ability to have a high upside capture as well and still maintain the consistency of performance outcomes. The issue that we're finding with our advisors, though, is that there is often a no free lunch when it comes to constructing a risk-profiled solution built for consistency. And it comes back to the old FOMO, the fear of missing out. At the top of the markets, when it often doesn't make sense to be fully invested, I'm sure Watershed are experiencing this as well, when clients are trying to chase these high returns, an advisor is using a real return framework, and they'll usually underperform compared to an SAA manager. Now, in my opinion, worrying about this is completely and utterly ridiculous. Performance is only relative in terms of what that means for a client actually achieving their wealth goal. The performance does not consider the amount of risk needed to achieve that performance and whether it's sustainable over the long term of the strategy. But with industry super fund advertisement, and I'm sure you guys are feeling at the moment, every time I watch Foxtel, there's a new advertisement for an industry super fund. They're only advertising return-only information, and it's upon us as managers to support the advice network via communication tools to this way of investing. Now, as for how we're positioned within this current market and to best handle sequencing risk, we see our real return suite of portfolios come into a really interesting time. We've gone into our highest conviction positioning for defensive assets during our 9 years periods of managing money under this process. We believe clients are highly susceptible to sequencing risk and are not achieving their wealth goals. Now, where we're currently positioned is completely different to that of an SAA manager. For example, in growth assets, we're seeing better risk returns within Europe, specifically in the UK, within European financials and European energy, rather than in the traditional US markets. We're positioned mainly for shorter duration bonds and seeing opportunity within emerging market debt compared to that of the longer duration US dominant bonds. And whilst it's uncomfortable, we're sitting on really high levels of cash. This is mainly to protect the portfolio, but also to use as dry powder for when it makes sense to buy assets when they become attractive. Now, all this needs to be linked back to one question. And now, as Carl Richards, one of our Morningstar consultants, so basically puts it, what is it that we as investment managers are trying to achieve? Are we here to beat each other, or should we be focusing on helping investors achieve their goals? With the combination of great strategic advice by you, the advisor, and the flexibility you have within building a multi-asset investment solution, we can help manage sequencing risk and then the effects it has on the clients achieving their wealth goals. Now, with that, Toby, I thank you, and I'd love to answer any questions you might have or anyone here listening into that.
Thank you very much, Michael. I'd like to go back a couple of slides to this one, which looking at this, the question it asks me is your approach to managing a goals-based portfolio simply dynamic asset allocation with broad ranges?
It fundamentally is up to how the portfolio is constructed from a benchmark perspective. If it is to beat a multi-asset growth portfolio, then I would agree that would be more that I would call dynamic asset allocation. If the goal is to focus from a CPI plus objective, then the question is, does investing in this give us a better risk return than investing in cash? And if the answer is no, then we don't invest and we hold cash. So I actually included a few extra slides in here today, because I knew you'd love to ask this question, Toby, in terms of where we are seeing current opportunity. And this is looking at a real return over a 10-year time frame. And what you can see there in orange is in terms of the return stream that we've actually had. Can everyone see that? Yep. In terms of what we've actually had in the last 12 months. And you can see when we're building portfolios, it looks completely different to that of a dynamic asset allocator that are using a multi-asset growth benchmark. And yes, you do have flexibility from your long-term asset allocation range, maybe 10 or 15% either side, but you need the ability to go down to zero to be able to manage that sequencing risk.
So do you just want to explain what this graph is showing, because it's reasonably complex?
Sure. So this is looking at the real return over a 10-year time frame. So we do this for over 350 asset classes on a monthly basis, and that's looking at growth assets, defensive assets, and currency as well. So this is saying that for European telecoms, we think there's a real return over a 10-year time frame of just under 5%. And the reason is that we've had a now that looks like a sort of a 9% return over that time frame in that market. So it's now become less attractive. That's what that orange bar is saying. So if we look at Australian property, we know that that's had such a great run in the last 12 months. And that whilst that was attractive at some point, a lot of the expected return for that asset class is now being captured. And as a result, you should reduce that within your multi-asset portfolio.
And so the orange bars here are your current weight to that sector or an expected return?
No, that is actually the return that's already been captured in orange.
Right.
The blue is what we expect for a 10-year time, a real return over a 10-year time frame.
Okay.
So as you can see, where we are seeing opportunity is more towards the left in terms of European telcos and financials. And if you think of the sentiment behind that, a lot of these are beaten up asset classes, but in terms of you are getting rewarded for the risk that you are taking within these asset classes compared to something like a US, which you can see is towards the middle.
And what would be the process of actually constructing a portfolio to take advantage of these views?
Well, as I said, the starting point is cash. So when we're saying, is this going to give us a better risk reward for cash? And then having if we just jump back a slide, sorry, we're obviously working within a risk profiled frame. So we want to make sure that, yes, while someone is still entering a balanced section, they still have return expectations, but the ability is that we be able to reduce as much as we possibly can, but yet still providing that consistency of return. So the first point is this giving me a better risk return than cash? If it is, then we size it appropriately to be within the portfolio, but then still focusing on trying to maintain that consistency.
All right. Look, Michael and Adrian, thank you both very much for your presentations today. I feel we find ourselves in an asset class outlook that really is quite disturbing, and certainly with less clarity than any market that I can recall trying to run portfolios in. I hope you've found today's presentation of interest. We'll be placing the recording up on the website over the next day or so. And just to remind you, the Portfolio Management Conference on August the 6th and the Managed Account Awards event on June the 25th. We'd love to see you in person at both of those events. So thanks very much for your time today.
Thank you.